Thanks for showing interest in Shark Cap Table Fast, the 1-minute deal maker. I'm going to show you how to structure a capital raise. You're going to manipulate 8 input spin buttons located in this section down here. And it's going to drive 3 deal metrics that are going to work for you and the sharks, and you find those up here. And by the way, if you don't want to call them sharks, you can call them investors, because some people might not like to be called sharks. So here's what we're going to do. You and I are going to form a business. We're each going to put $5,000 in it for a total of $10,000. Your skills, your internet deal, some pre-money test revenues, my experience, and we think this company's worth $200,000 based upon considerations such as market size, management, intellectual property, test revenues, and skin in the game. Now, we need to raise $300,000 to get this company kicked off in high gear. We think we can sell in year 4 for about $2 million. Now, I forgot to do one more thing. We need to give ourselves 1 million shares collectively. And now the investors are going to have an idea of what our company is worth, and generally they never give you the same. It's always less. When this pre-money is reduced, it gives them a bigger share. When this is increased, watch what happens. When it's increased, notice the investor stake drops. So let's go back and set it at 200. Let's make it 175. This comes up red because it's less than. Now, what kind of a deal have we made? Well, the investor I multiple is 4.21. The IRR is 27%, but the investor stake is 63.2%. We need to get it down to the 40 region. So let's try doing it this way. Let's add another $1 million to the sale. Make it in year 5. Now that's made the internal rate of return a little bit better. So maybe we've got the right to say, look, we've got a little, maybe $200,000. Well, this pre-money value increase still does not get the investor stake down. One of the things we might do is we might actually put more money into our business. Let's say $50,000 instead of 10. Now that brings us up to a founder valuation of $240,000. Maybe we could ooch this up a little bit. And remember, this is a scenario. We're playing around to find the right numbers and how they might work and what the trade-offs would be. So let's say we can go back to about 275. Well, you see, we're almost there. Let's see what number of pre-money value we'd have to go to get to 40%. Oh boy, 450,000 versus 300,000. Not likely. We're going to be lucky to get 300. So let's ask for less money. Let's go down to about $200,000. And there you go. $200,000 gives you a 40% investor stake. 34% is okay, not a barn burner. And 6 investment multiple is all right. Notice our red logic says that 30 to 40% internal rate of return. 2 investors nibbling, 3 are watching. Well, we might have a deal here, although this is not real strong. We provide a couple of sentences, which we call an investment summary, and it's based upon these critical numbers. And you can cut and paste and put that into a business plan or an executive summary or a pitch deck. We also can print preview. Let's see, print preview. There's a little print preview right there. Actually, that doesn't work out all that well because we're missing some of it, but at any rate, it does print as a preview. So, escape. Here we are. One more thing, we've got a little spin button up here which gives you up to 14 different suggestions. Kind of fun, spin up and down. And there you have it. Thanks very much. Be sure you come visit us at sharkcaptable.com. We have a product that has more power. It's called the light version. It includes royalties, which are an excellent way to raise money for a deal without losing control. Royalties are non-dilutive. Let us hear about how you're doing with your deals. If you get stuck or need some help, give us a call. We may